This video is going to be short and sweet, I hope, because it's a bit of a mea culpa. In my last video, I complained about bonds and how they might not help you as much as you think in early retirement. Now, in that video, I think I had three main points. One, that bonds are helpful for the psychological benefit because they help keep your portfolio stable, help it keep from going down too much when the market goes down, and at the same time, they provide some dry powder so when the market does go down, you can rebalance and buy more stocks at lower prices. So bonds are helpful to stay the course. They're good for that psychological benefit. My other point was that bonds tend to be locked away in balanced funds or target date funds where you can't separate the bond part from the stock part of the balanced fund. So if the market is down and you want to pull money from your bonds, you can't really do that because they are tied in with the stocks inside of a balanced fund. You can only sell shares of the fund as a whole, not just the bond portion or just the stock portion. And my third point, and probably the main point of that video, is that bonds are not helpful if they're locked inside pre-tax retirement accounts like traditional IRAs or 401ks, because you can't access your bonds in those accounts without a penalty. But at the same time, that tends to be where bonds live because that's the correct location for bonds from a tax perspective. As much as possible, you want your bonds to be in those pre-tax accounts instead of a Roth IRA or a taxable account. And just real quick, the reason that you don't want them in a Roth IRA is that you want the funds, the investments inside your Roth IRA to have the potential to grow as much as possible. And that tends to be stocks, not bonds. And the reason you don't want your bonds in a taxable account as much as possible is that they are tax inefficient. And every single time they pay out interest, you're going to pay tax on those if they're in a taxable account. So people tend to have their bonds in pre-tax accounts, and that includes me. And that's the correct location. But unless you're 59 and a half or older, you can't get to those bonds without a 10% penalty. At least that was my point in that video. But on that last point, I got it wrong. One of my viewers very helpfully explained how you can access bonds from a pre-tax account in early retirement with, as they put it, zero or minimal tax implication. So the viewer writes that the bond problem you describe can be solved in 5 minutes with zero or minimal tax implication. The most common scenario, you keep all your bonds in traditional IRA accounts and stock in taxable. When you need to sell $10,000 of bonds to fund your expenses, you perform the following 3 steps. Step 1, exchange $10,000 of bonds to $10,000 of stock. So let's imagine you have $10,000 of bonds in BND in a traditional account, and you exchange them for $10,000 of VTI in that same traditional account. So you've sold $10,000 worth of bonds and you've bought $10,000 worth of stock. Now we turn to step 2, sell $10,000 of stock, VTI, in your taxable account. And then step 3, transfer $10,000 of cash from that taxable brokerage account to your checking account. There you go. This is a brilliant idea. This is the way to do it. The reason this works is that money and your investments are fungible. So instead of trying to take the money out of the traditional IRA directly by selling bonds and just taking that money, you do a little swap instead. First, you exchange $10,000 worth of bonds for stocks inside the IRA. That's just a trade. It doesn't create any taxes or penalties, no problem there. Then over in your taxable brokerage account, you sell $10,000 worth of stocks, the same amount you just bought in your traditional IRA. So your stock allocation at the end of the day remains the same. You just have $10,000 more of stocks in your traditional and $10,000 less of stocks in your taxable account. It's a wash. But at the same time, you now have $10,000 sitting in cash in your taxable account, and you can transfer that to your checking account. You can spend it. You can use it to fund your living expenses, whether in retirement or early retirement. The result is that you've effectively spent $10,000 of bonds without touching them, and you avoided any penalties or early withdrawals. All you did was rebalance your portfolio across 2 different accounts in a smart way. Why does this work? Well, you're avoiding the penalty because you're not withdrawing from the IRA. You're just trading assets within it. you have no tax hit or possibly a minimal tax hit. If your taxable stock is long-term capital gains and you've planned well, there should be no or minimal taxes as a result of selling the stock in your taxable account, but that is something you want to plan for and think about before you do it. And overall, big picture for your entire portfolio, your portfolio stays balanced. You just shift your risk exposure appropriately between these two accounts. So that's really it. And I'm kind of embarrassed that I got it wrong in that video, that I didn't think about that. And I definitely wanted to set the record straight by making this video and correcting that previous video. Because honestly, I don't want anyone dumping out of their bonds or changing their asset allocation because they watched that video. And what really gets me is that I know that somewhere along the line, in my years and years of reading blogs, reading about investing, listening to podcasts, watching videos, somewhere along the line, I know I've heard that concept before. And because it totally rings a bell with me when I read my viewer's comment. It's like, yes, that is brilliant. And I know I've heard that somewhere, but I guess I'd forgotten about it. And with the recent market downturn we had, I started really thinking through the scenario of what if the market is down and I've already retired early? How would I access my bonds? How is that really going to help me in early retirement? And are the bonds a help in early retirement besides that psychological benefit that I talked about? But it turns out they are very helpful. If you want to think of your allocation in bonds in terms of years of expenses, that's totally understandable. That's a good way to think about it actually, because you can access those bonds in those pre-tax accounts by shifting money around, doing this little dance. And of course, this assumes that you have a pretty substantial amount of investments in a taxable account. And this is another great argument for having multiple types of accounts with multiple types of taxation. Having taxable accounts, pre-tax and post-tax retirement accounts, health savings accounts. The more variety of different types of accounts and different types of taxation that you have access to, the more flexible you can be in your retirement, including your early retirement. So for me personally, what all this means is that I feel much better again about holding bonds, whether it's bonds, bond funds, or short-term cash equivalents, like my Treasury ETF, SGov, having something to help you stay the course besides your stock allocation, and having something to draw from when stocks are down, not having to sell all my stocks when they're down in early retirement. Bonds are absolutely there. I can pull from my bonds using this method described in this video. And even if you've retired early, this is a way to access your bonds, even if they are tied up in a pre-tax account. So thanks again to that viewer for pointing out that important point. If you enjoyed watching this short mea culpa video, give it a like and check out this video next. Thank you for watching. You do a little swap-a-doodle-doo.